Imagine this. You finally find your dream home. The backyard is perfect, the kitchen has the island you've always wanted, and you can already picture the holidays spent inside. You check the monthly payment, and it looks manageable. So you rush in, sign the contract, and think you're set. But then reality hits. Property taxes add hundreds of dollars you didn't expect. Homeowner's insurance sneaks in, and then PMI, mortgage insurance you didn't even know existed, shows up on your bill every month. Suddenly, what you thought was affordable now feels like a financial trap. This happens to thousands of buyers every year. The good news? It doesn't have to happen to you. Today, we're breaking down exactly how much house you can really afford. Not just on paper, but in real life. And more importantly, how you can save yourself from years of regret. When lenders talk affordability, they don't just look at the mortgage. They use a formula called PITI: principal, interest, taxes, and insurance. Most buyers only focus on the first two, principal and interest. But here's the truth. Skipping taxes and insurance is the #1 mistake that makes home unaffordable. Take an example, a $400,000 home with a 30-year fixed loan at today's rate of 6.25%. Your principal and interest might look like $2,400 a month. Not bad, right? But then add $500 for property taxes, $200 for homeowner's insurance, and $250 for PMI. That's $950 extra every month. Suddenly your $2,400 payment has turned into $3,350. That's nearly $1,000 more than you expected. Every month. That's why understanding PITI isn't optional. It's the difference between peace of mind and buyer's remorse. Now let's talk about closing costs, the silent budget killers. Mark, a first-time buyer, thought he had everything planned. Down payment, saved, monthly mortgage, budgeted. But when he walked into escrow, he was blindsided by the extras. Appraisal fees, title insurance, escrow charges, loan origination fees. Together, they added almost $12,000 in one shot. Here's the truth. Closing costs usually range between 2% and 5% of the home's price. On a $400,000 home, that's $8,000 to $20,000. If you don't prepare for that, you'll end up draining your savings or, worse, adding it to your loan and paying interest on it for decades. Smart buyers don't just plan for the down payment, they plan for the closing table. That's how you protect your savings from regret. Here's where most buyers leave the most money on the table: down payment strategy. Sarah, another buyer, decided to save a little longer before she purchased. Instead of rushing in with 3% down, she pushed for 20%. That meant no PMI. While her friend Mark was losing $250 every month in mortgage insurance, Sarah kept that money in her pocket. Over 20 years, Sarah saved nearly $60,000 just from avoiding PMI. Now, if you don't have 20% down, don't panic. You're not stuck forever. Many buyers refinance later once they build equity, or when interest rates drop. But remember, every month you wait to refinance is money leaving your wallet. That PMI could be $200 to $300 a month, and that adds up fast. Let's talk about interest rates, because even 0.5% makes a massive difference. Right now, rates hover around 6.25% upon publishing this video. But let's say you hesitate, and by the time you lock, rates jump to 6.75%. On a $400,000 loan, that 0.5% means an extra $130 every month. Doesn't sound like much? Over 30 years, that's nearly $47,000 lost. Now imagine rates swing a full percent higher. That's over $250 more per month and nearly $100,000 more over the life of the loan. This is why timing and locking your rate matter. A smart lock at the right time can literally save you a six-figure amount. Sometimes affordability isn't just about cutting costs. It's about expanding your tools. For homeowners over 62 years and above, a reverse mortgage can free you from monthly payments and give you flexibility in retirement. For younger buyers, a HELOC can provide a second line of credit to use for down payment or renovations. Investors use DSCR loans or bank statement loans when traditional financing doesn't work. These aren't gimmicks, they're strategies. And when used correctly, they can protect your savings and help you afford more house without draining your future. Affordability also comes down to strategy at the table. Most people don't know they can shop for title and escrow services, but you can. That alone can shave $500 to $1,000 off your closing bill. Timing your refinance after a dip in rates can save thousands. Even negotiating seller credits toward closing costs can mean walking away with money still in your savings account. Every dollar you negotiate is a dollar you don't regret later. So how much house can you really afford? It's not just about what the lender approves. It's about what protects your savings. It's about knowing that PITI makes or breaks your budget. It's about preparing for closing costs before they sneak up on you. It's about eliminating PMI when you can, and knowing how much it's costing you if you can't. It's about locking your rate strategically and exploring financing options that protect your long-term wealth. Affordability isn't just a number, it's a strategy, and if you ignore it, the price is regret. Don't let regret steal your dream home. Don't let thousands slip away because no one told you the truth. If this video opened your eyes, do me a favor. Smash that like button, subscribe to Money House Media, click the link below and get the free 10 steps to your first home, and share this with someone who's house hunting right now, because the more you know, the more you save. Here's today's real estate reflection. It's not the house that makes you wealthy, it's the wisdom in how you buy it. Thanks for watching, and we'll see you in the next video.